Okay, the topic for today is alternative financing for growth stage healthcare businesses. We have a panel of four to my immediate left. First is Greg Pecos, who's an MD with Silicon Valley Bank and Healthcare Life Sciences. To Greg's left is Max Kahn with Merck Global Health Innovation. Thereafter, we've got Brad Smith, who's the CFO with OmniGuide, a device business up in Boston. And to the extreme left is Matt Reber, who's a partner with Healthcare Royalty Partners out of Connecticut. And I am not John LeClaire, who was not able to moderate. So my name is Ilan Nissan. I'm a partner in the private equity and technology group at Goodman Procter in New York. What we'd like to do is have each of the panelists spend some time talking about what they do and what their experiences are in various alternative financings with regard to healthcare businesses. And the paradigm case, I guess, is that you're a company, you're getting to the E, F, or G alphabet round of preferred, and you're tired of giving away equity, or on the other hand, you're an investor representing a pool of capital, or a pool of capital backing you, and you're competing with a bunch of other investors in a scenario in which the company is at a point in time when it's not necessarily willing to continue to give up equity and suffer dilution in its capital structure. So we turn to one of these four to figure out what alternative scenarios there might be, and what the costs, benefits, and market trends are with regard to them. So why don't we start with Greg, who's with Silicon Valley Bank, so I suspect we'll be talking about debt a little bit first.
Thanks a lot. For those of you who don't know much about Silicon Valley Bank, we are a commercial bank, sort of a traditional bank. However, we've got a unique focus on, or narrow focus on just healthcare and life science and technology. And we also range from very early stage companies to growth and then to late stage companies, where I end up spending a lot of my time lately. And given some of the panelists here, we are often trying to find ways to either extend the runway, create sort of a bridge financing, or doing everything from early stage buyout type deals. And we do a lot of late stage leverage finance deals. But early on, we tend to focus on a company's, I guess, VC backing on the early stages and where they are in their product life cycle, and can offer some traditional financing, venture debt financing, which is often looking pretty specifically at cash burn, and is mildly dilutive, I would say. But also in probably the middle stage rounds, we can oftentimes offer a product that's more mezz-like, which will provide some, probably 3 years worth of non-covenanted type financing, as well as non-amortizing, which may or may not have some warrant coverage or minimal warrant coverage. But basically, we see all types, and we're often called in as a potential solution to allow a company to grow, keep growing without being very dilutive.
You want to go next?
Great, sure. Hi, my name is Max Kahn, and I'm an investment principal at the Merck Global Health Innovation Fund. We are a venture capital and growth equity fund. We have a commitment of $500 million from Merck, so we do invest off of Merck's balance sheet. But we are actually investing completely outside of Merck's core and looking for instead complementary technologies within, in data-rich companies, as Merck is looking to move beyond the pill and become part of what's evolving to be the more integrated solutions that are going to take care of illness and chronic disease moving forward. So an example could be in the cardiovascular space, where you might leave the doctor, instead of in the past where you would just leave the doctor with a prescription, hopefully for one of Merck's medicines, you might leave the doctor with a care plan that you need to follow, a monitoring device that's providing information as well as a prescription, and how do you provide better integrated solutions across those things going forward. So that's why we're not investing in the drug side, where our core business is very focused in it, and we have a lot of obviously capital and ability to do that, but rather on the other parts of that solution moving forward. So, we do our fund does traditional equity investing. But what we've seen, though, and in particular coming from pharmaceutical companies, is we have seen what is in essence funding for a company that's coming directly from the core business. And it's often not equity funding, but it might have a small equity component. And we've seen two prime examples of this. One would be is we actually have a portfolio company, and this portfolio company is a heart monitoring company. The reason that we invested in it is not the device itself, it's the back-end analytics and platform that they have for analyzing the data coming off of the devices and what to do with that data. Because of that capability, they have a great capability in building platforms and building applications for the web in all sorts of different medical type of situations. What this company has done, even though the monitoring piece is the core business, and that's the business that we invested in and why we like them, but they also sell their services for building platforms and back-end solutions to pharma companies. We actually are also a customer on that piece of it as well. And so this has created revenue, which isn't really revenue going toward, and doesn't have great growth prospects, and is not something that we as investors would invest in. But it does create cash flow that has reduced the amount of capital that's needed to be required to raise the business to develop the monitoring solution and the monitoring size of the house. So that would be one good example. The second good example is we've also seen companies that have, in essence, raised development money for the further development of their platform or their product. And that could come in there's a couple different flavors of that. So one might be is that, and we've seen Merck do this as well, not necessarily with one of our portfolio companies, but Merck likes the core capability, but Merck wants to have that capability as an offering that they're going to eventually sell. But the capability isn't exactly what Merck wants, or it needs to be modified in some form or fashion, different than just customization in terms of selling it to a normal customer. So we've written checks that have gone to the development of this platform. We may take a intellectual property interest in specifically what was developed. We may exclusively own in specifically what was developed, but obviously that cash goes back to the company in a way that they can leverage and use, and it really ends up being financing as well. We've also seen, this isn't something that Merck's done, but it's a company that we looked at. We've also seen where there's a product that's not a traditional pharmaceutical product, but where the company wants their sales force to sell it. They think it's something that they can add value to. It complements their portfolio, et cetera. And again, the company isn't quite ready, though. They're still have cash needs, and they have negotiated deals where the pharmaceutical company, or it could be a medical device company, whatever it is, actually pays them for the right to sell the product. And then would also have some revenue split going forward as well. So that could be, what you might give up there is you might have to give up an exclusive. You might have to give up that certain other customers don't have access to it, but other potential customers would. You might have to give up, in essence, either a revenue share or some form of royalty. But again, you're not going to give up as much as you would in raising a round of direct equity capital.
Do you typically find that one of those deals works differently depending upon the type of healthcare business it may be, whether it's IT or technology-based versus device-based or pharma, biotech, what have you? Yeah,
so most of what we've seen, and because of the space that we're in, is more on the services or the IT side, right, and the HIT side as well. I think that Where we have seen it in maybe a little bit more of traditional life science is when, again, not necessarily in the core platform, because if it's the core product or the core platform, that's probably going to go down a more traditional route of either requiring equity financing or some sort of licensing deal in the way that a biotech product might be licensed. But what we have seen is that if the company can leverage that platform in a different setting, they can sometimes generate the same kinds of deals, whether it be a development deal as well. We've seen that definitely in the diagnostic space, where sometimes our R&D organization will use that product and might do some funding to help develop the platform so it can be used with a clinical trial, would be a good example. So that would be, so there definitely, I don't know that I've seen it quite as much in the life sciences setting, but there definitely are applications for it in the life sciences setting as well.
Brad. Great. So Brad Smith, CFO at OmniGuide. OmniGuide is a commercial stage medical device company based in Cambridge, Massachusetts, which of course everyone knows is the center of the universe, right? We're venture backed. We've raised $80 million to date. The product is a hollow core fiber that can deliver CO2 laser energy for very precise surgical cutting. And the advantage of our product is precision and safety. So it's safer and less damaging to tissue than cautery and many other devices on the market. So we're starting to get some very good, serious commercial traction. As we looked at different financing options, as I said, we've raised $80 million in equity to date. We've done a Series E round. That was our last round. So we looked at another equity round, and we also took a look at the royalty-based debt financings, which my friend to my left here will talk about. And we actually elected to go down that path. And I'll talk in detail about the considerations and how we evaluated that. But under either scenario, it involved the D word, right? Another equity round, dilution. Our investors were pretty sensitive to dilution. And the royalty-based deal, of course, puts debt on our balance sheet to a much larger degree than we had with traditional venture debt. The attractive thing about it was we believe we can get our business to EBITDA positive probably within the next 18 to 24 months and at a lower revenue rate than most medical device companies have been able to attain EBITDA positive. So because of that, and because of the concern our investors had with dilution and the attractive aspect of doing a royalty deal and getting 4 years interest only, non-amortized over the first 4 years, we elected to go down that path. And also just the amount of capital we were able to get. So we ended up doing our deal with OrbiMed. And another consideration is, they can become an equity investor over time as well. And again, I'll go into more details about why we chose that path versus equity and what we thought some of the pluses and minuses were in more detail. And just in terms of alternative financing strategies, I've been involved in 5 different emerging growth companies in the industry across biotechnology, devices, and healthcare information. And IPOs, private rounds, venture debt, royalty-based debt. So I've had a lot of experience with different financing structures. Great.
Matt. I'm Matt Reeb. I'm a principal with Healthcare Royalty Partners. And for those of you who aren't familiar with us, we're a private equity style fund with about $1.5 billion under management. We were known as Cowen Healthcare Royalty Partners until, I guess, about 9 months ago. Same firm, just dropped the first word there. And our focus is on investing in healthcare royalties and products. And we do that in, I guess, 2 fundamental ways, although there's a lot of different flavors. About half what we do is acquiring or financing existing royalty streams, so kind of a passive royalty stream that a company or even an inventor or an institution is receiving on an existing license agreement. And that can be growth financing as well. We've done deals with a number of growth stage companies that have gotten one product approved through a partner and then monetize a royalty and put that into the development of their kind of proprietary internal pipeline. But probably the bigger chunk of what we do that's relevant to this conversation is the other half of our business, which is really kind of structured finance for growth stage companies. And a big piece of that we do in a product we call a synthetic royalty, which is, I think, pretty similar. Again, many flavors to what OmniGuide did, but it's a debt-like structure where at least some component of the return is royalty-based or a percent of sales-based, and that can have look more debt-like and have explicit kind of principal and amortization, even a coupon with a royalty kicker, or it can be look more like a traditional royalty with maybe some fixed payments and have all the profit or interest be more of a variable component. And those are things that we just kind of weigh with the company in terms of what's the best fit for both parties. In terms of our approach, I'd say two basic tenets. One is a real asset focus, kind of coming from our traditional, our origins in royalties. We do a lot of fundamental asset diligence, meaning the product itself. That's the asset that we're looking at. So commercial forecasting, IP diligence, clean reg diligence, manufacturing. That's what we're looking at in terms of the value is the product, as well as flexibility. I think our structure is designed to fit with a growth stage company and allow them the flexibility that they need to prosper, as well as the structures that we can employ. There's the royalty, the synthetic royalty. We can invest straight debt, we can invest equity, we can do project financing type structures. It's as long as we fit in the right risk-return profile, we have a lot of flexibility in that way. As an example, or as a kind of few examples to give you a sense, December last year was a really busy month for us. We closed 4 deals. One of them was a royalty monetization for Inventure on Lyrica, which is a north of $100 million deal actually, so traditional passive royalty. One was a monetization of basically kind of guaranteed payments in a company that sold a product, so kind of a structured finance product. We did a deal with Raptor Pharmaceuticals, which is a public company that has an orphan drug in front of the FDA right now, where we invested $25 million in December before approval in a synthetic royalty structure, kind of a debt plus royalty kicker structure, with 25 going in upon approval. And then we invested in a company called Neuron Biotech, which is a private company that has a portfolio of late development stage products and vaccines and neurology, and then acquired a commercial vaccine from Pfizer called Meningitech. And we did a deal there where it was 50 in kind of a synthetic royalty, but also 30 in equity, which is what they needed, what fit their capital structure. And since we could do both pieces, it, I think facilitated that in an acquisition scenario where it was fast-paced and we kind of had to get to speed quickly and work in kind of commercial time to get that done. In terms of our team, we've been together since 2002, basically doing the same thing, although it's evolved over time. Initially at a firm called Paul Capital Partners, and we've invested about $2 billion so far in 40+ deals through the course of those 2 firms. So I can go into more detail on kind of where exactly we fit and where we can be attractive, but that's a good starting point.
Since you both, since Brad and Matt both went at the end, I guess, Matt, your company decided to go with a royalty type structure. I was hoping both of you can talk about what considerations you're seeing that companies, well, maybe let's talk about the 1 or 2 prototype transactions that maybe you, Brad, had considered, and what you're seeing in terms of what the competition is offering your companies, Matt, and what is motivating people to make decisions. And in your case particularly, Brad, what motivated you and your board to go in that direction, and what considerations you found to be the most relevant in helping you make that determination?
So when we were looking to raise money a little over a year ago, as I said, we looked at both equity and this royalty debt structure, in our case, the synthetic structure. And the considerations were, so the company had raised $80 million to date. Given that we're at an advancing commercial stage and have in our sights getting to EBITDA positive, it was a pretty big consideration to our investors, again, was dilution. And just not wanting to be diluted, having put that much money into the company. And again, the other was just where we were in terms of our commercial stage. There's no way we would have considered the structure if we were at an early commercial stage and looking at the ramp that we had. So I think we had to get comfortable with our business model and with our projections that even if we're 75–80% to plan, that it's a viable structure for us. And it doesn't mean we can't do a follow-on financing and even go back and do another equity round, but it certainly complicates things. And I think it's a great structure. It does add a risk element to the business that you don't have there, if you've got equity. But so the considerations really focused around dilution, the stage of development, getting the fact that the company, we believe, can get to EBITDA positive within a reasonable period of time. And so we looked at the risk and said, hey, this is manageable for our business.
When you say the risk element, Matt, is that something that, do you look at this as I know you don't, but maybe you could tell us how you look at it different than a traditional, sorry about using the word traditional, but a lender like Silicon Valley Bank might look at it from a pure collateral or cash flow perspective in terms of enforcing rights or taking actions in the event that there's an adverse effect or something, something not in accordance with plan happens.
Yeah, I would say, so I think, so again, our focus is on kind of the product asset itself. I think that's what we're looking at in terms of our collateral, not kind of physical assets or cash or things like that. It's more of a forward-looking approach. I mean, we're doing our own commercial diligence. We're have a forecast for the product, so we can invest at product launch or very early stages, and we're making a bet on where we think the product's going to go. And I think our general mentality with that as a backdrop is I don't know, a little more kind of aligned with the equity investors, where we make more money if the product's successful. We're trying to provide kind of continuity in those kind of situations. We reserve capital to follow on in our investments. We can invest equity alongside it. So I think that's kind of our our mentality, and we really are looking at the product itself. It can be very early stage, but we want to think about what's kind of a downside case for this product in terms of sales. What would it be worth at that point in time? Do we feel like we could get our money back, or have a certain amount of over collateralization? That's kind of it's a lot of things we look at, but that's probably a big big piece of it that may be different at an earlier stage or with traditional debt.
How are you modeling your expected returns as opposed to a more traditional VC or growth equity investor in terms of what your expected returns are for a transaction like a royalty payment structure?
So we'll have a variety of scenarios of different revenue forecasts that we'll model. I think we'll have a certain target return based upon our view of the risk profile of the company. We do have a band. In general, we're targeting kind of a high teens return as a portfolio, but we're looking at things from the low teens to the to the mid 20s, depending upon the particular risk. And so we'll look at those scenarios and really looking at a downside return when we're preserving capital or getting a return above our pref, and then base case that hits our base case return. And we're usually willing to trade downside protection for upside. So we're like traditional debt, we are providing leverage in a good way. Our returns are either explicitly capped or they have step downs, et cetera. So wild success, we only do so well or can be bought out. But in exchange for that, we're looking for downside protection with some fixed payments or tiered royalties that are higher on the lower level of sales and then decline, and things like that.
So the venture debt that we had in place prior to doing this royalty structure was all in 13-14% cost of capital. Mm-hmm. No question that the structure is more costly, and we're in that high teens. But when you think about what you're getting access to a lot more capital. Instead of maybe a 12 or 18 month interest only period, you're getting 3 to 4 years. In our case, 4 years. So there's a lot of benefits that you're getting for that additional cost. And then if you compare it to typical cost of an equity round, it's cheaper. And as long as your business, you're confident in your business model and your projections and where the company's going, it can be a very good structure.
I'd say we usually end up fitting best or being the right choice when people are looking at us relative to equity versus relative to traditional debt. If it's kind of a growth, equity stage and kind of substitute, right? But for whatever reasons the company doesn't want to raise equity, it's dilution, valuation. Existing investors have limited reserves, or some have limited reserves, and there's just it's tough to go out and raise an outside equity round, in that regard, and they need a big, a larger amount of capital, and are looking to really grow through a couple years of execution and not just the 12 or 18 months to some milestone. I mean, that's where we really fit, kind of fit best. If a traditional, SVB loan would actually serve their needs, and they're going to be looking at the lowest, the lowest coupon rate, then that's not going to be the best fit for us. But we do have, I think as Brad mentioned, much, longer IO terms. Very back. These structures can be, 6 to 8 years in duration with a lot of, any fixed payments towards the end, limited covenants, if any, real, financial type covenants or anything like that. We're much larger, we reserve capital, so it's kind of it's much more akin to kind of an equity scenario than a kind of a traditional venture debt scenario. And that's where I think we end up fitting in best and end up being the right choice when people are considering equity versus us, as opposed to looking at venture debt at the same time.
And Brad, just to add on to, I guess, Brad's comment too, and Matt's on. It depends on the stage of the company, and we get to. It's interesting. We provide solutions across many different companies, whether it's traditional med device or true life science diagnostics companies, lab businesses, as well as healthcare IT and sort of faster growing, faster to market, I guess, growth stories, whether it's a unique a SaaS-based platform focused on healthcare IT. We tend to fit depending on that stage of life cycle. And as Brad mentioned, it's typically a smaller amount, but sometimes if there's a fast-growing potential exit or an IPO, providing sort of a bridge just pre-profitability or EBITDA growth, we can be a decent solution that is mid-teens, low to mid-teens, and we get plenty of opportunities there. But it is typically augmenting an additional or augmenting the working capital side, or augmenting a Series C round or something like that, where we're supportive.
But aren't you able to also provide other services to the business that perhaps you guys aren't set up to do, like cash management services, services?
All of
Trying
that.
to promote everybody equally.
No,
and give everybody their fair share.
And we truly provide all that, the traditional products to help a company grow.
OmniGuide is a user of those services, of SVB.
Yes.
And Goodwin Procter, actually.
There you go.
But no, there's lots of opportunities for us to play and compete. I mean, in the back, Matt and I were talking about a pre-commercialized, pre-approval pharma company that we looked at providing what we thought was a pretty substantial, very flexible line of credit. But given the needs and the growth prospects of this particular company, we were limited in, 50 to 75 million didn't seem to work given the structure, and we knew that, and actually provided that consultation to the company, someone that we will still be a good and valued partner. We had been for 12 years and still are, but we also suggest alternatives that will help the company grow.
Would you participate in each other's investments in any scenarios?
We've attempted to. It gets a little tricky with the IP, how broad the collateral package is on a royalty. Sometimes it reaches beyond but we've attempted to in the past.
We're invested in the same companies where we have different, different.
You're different places in the cap structure.
I mean, usually we're first lien in certain circumstances. We've been second lien to SVB, at least for a period of time. And we have explored. I think we're open to co-investing. It doesn't happen as often in our space as it does, in the venture community, but we certainly are open to it.
And we can also provide services to help the funds.
That's
as
right.
well.
There you go.
So they can be a customer.
So for us, that was another difference between our traditional venture debt and the royalty deal. So we have a first security, well, our lender has a first security lien on all our assets, but they have a first security lien on IP as well. as opposed to a negative covenant that you typically have with a venture debt financing.
And
and that's just a factor of we're looking at the product as our collateral, right? And so you need to have the IP and the approvals and the data and all those things that you can package together and have a product that you can sell. And I think we often get the reaction from people since they're used to more the venture kind of debt paradigm where you have a negative pledge, but it's not a hindrance on people being able to do their business. Even licensing businesses where it's a platform technology, it shouldn't get in the way of that. It's really, in the unfortunate downside scenario, at least you have the collateral you need.
Max, I was hoping to ask you, since your fund really invests equity, have you seen these types of transaction structures when you've been a pre-existing investor, and how have you guys perceived them and structured your equity securities in anticipation of them or otherwise?
Yeah, we haven't actually come across a royalty deal in one of our portfolio companies yet. We have had some SVB debt in the companies, I think the perception is usually based on stage, in the sense of when we are looking at the company and they have some debt sitting out there, what's the company's ability to pay it back without it necessarily having to be from an equity round? I think is really the biggest question we have. So we have seen a couple times where maybe the debt was raised a little bit early, and then it becomes a bit of an issue because the lender probably wants to be paid back, and we're not looking to put our capital into the repayment of debt. We want to be putting our capital into the growth of the business and the development of the business. So I think that is, thinking about earlier stage companies or companies that are farther away, even if they're not so early stage, farther away from being cash flow positive and the ability to pay that debt back out of cash flow. I think a company should be thinking about it, well, even if I do get this debt, is it going to be a problem for me to raise additional capital later, because that additional company is going to need to be equity.
Do you guys ever finance, with any of these structures, finance liquidity for shareholders? Or is it purely investments in the company where the cash stays on the balance sheet?
We have not done that. I don't know that we'd say we absolutely wouldn't. It's never been a circumstance that's been brought to us.
The reason I ask is, again, we're in a situation where we're getting up to the F round of financing, and some of the earlier investors may be getting tired,
right,
and their funds may be getting long in the tooth, and they've got to return capital to their limiteds. So it may be possible to buy back their equity at a cheaper price, given the fact that they've got liquidity on their mind.
Yeah, I mean we're focused on our money going in and having a viable company that can reach cash flow break even, usually on our money being the last dollars in. I think like probably most people here are looking for that same opportunity. So I think that, in concept we wouldn't be opposed to it as long as the company was properly financed with the remainder of our investment.
We're in a situation where some of our early investors invested quite some time ago, and perhaps they're end of fund life, or whatever the issue might be. All of our investors are really happy with where the company is, but we've been approached by a couple of firms who specialize in secondary transactions, and it's not anything that we're really looking at seriously. But there's a number of firms out there who do specialize. Saints Capital is an example.
We actually did. Although it's a little bit different than in venture debt, we do have a company in our portfolio that has $15 million of EBITDA in it. And the reason that we invested in it is we invested to help them grow. They're a company that's not exclusively focused on healthcare, and their healthcare business was rather small. It actually originally had started in the forestry industry, believe it or not, and was founded by people in the industry. So it was founded by the forestry companies. They eventually made their way into healthcare, and they needed capital to grow. They didn't have enough capital from operations to really develop the healthcare offering. So that's why we made an equity investment. But these forestry guys, they basically at this point do want to get out. And in that case, as an equity investor, we're actually going to, we're looking for someone to buy them out, and we're okay with that. But we're also considering just using regular debt, not even venture debt, because of the fact that they're EBITDA positive to, in essence, do a mini leverage buyout. It's not going to put a tremendous amount of debt on the company, but we're essentially going to take equity holders out. We might, it depends on how this plays out, but we might take equity holders out by just putting traditional debt on it. And in that case, because we're comfortable with the cash flow covering the debt, and that we're okay with that, and we're okay that if we do want to put more equity money in for growth purposes, because maybe they're tapped out on the level of debt that they can have, that we'll still be comfortable in that case.
And we typically see that a lot in our business, where either a minority investor is coming in to clean up some either very patient or very tired investors, where we will provide debt alongside to help that, and then the new investor is providing the growth capital on top of that. But it typically is later stage, but still growth. And it can be substantial, as Brad, I think, mentioned. He's on a pace to sort of outperform this, getting to cash flow positive, a little sooner than a typical 100 million revenue stage company. And we have one like that that's just about break even, but has a significant investor coming in to augment our sort of line of credit and traditional debt.
Okay. We said we'd leave about 9 or 10 minutes at the end for questions. So please, do people have questions or topics that they'd like the panel to address or cover? Yeah.
Actually ask a question while someone wants to take
We'll bring the microphone around just a second.
So, over the last couple of years, it's interesting, people do want to avoid dilution and look at creative ways of financing. At times I've thought, wow, whether it's the royalty partnerships or the venture debt slice seem to be very aggressively funding companies. And at the time I thought, and we tend to be very conservative on leverage in our companies, I thought that the venture debt markets might have been mispriced. Obviously, you're still here on the podium and willing to cut checks. So, I've obviously missed something. But as you look at your portfolios, I take it you're making the target returns you need to.
Sure.
Across sectors, and maybe you could split because services is very different than med tech or specialty pharma.
Correct, and also within our sort of ability to do early stage, middle, and late stage. Certainly, the markets in general, and as I mentioned, I spent a lot in the late stage buyouts, and it is pretty amazing what's going on right now in terms of the competition, both from pricing standpoints and structure or lack of structure. For a debt guy, it's a little tough to compete, but we've learned to do that, and for certain companies. But in the growth stage, we're still finding a lot of opportunities. I'm surprised, and I had mentioned we have a mezzanine, or we call it a mezzanine fund, but it's more like a venture bridge facility that's been very attractive for some of these companies that you would think, and it's priced mid, 10 to 15%, but closer to 15. It's very user-friendly in terms of how we come into it. Oftentimes, we can do it on top of our senior piece, and it makes sense for folks. But
by the way, you guys did that for our West Coast company, Aperio, which we sold to Danaher last year. But
that's what I was going to say.
It was a perfect situation where some of the syndicate was getting aged, and they said, "Gosh, do we have to cut another check?" And you folks came in and actually bridged to what eventually became a nice strategic sale for everybody.
It works out on a case-by-case solution. I think it can be a very effective tool.
Thank you very much. Got a bit of
Anybody else? Thank you.